Okay. Now, when we're starting this, just to make it clear, it's best if there's as much interaction as possible. So as and when you have questions, please just ask. I'm very happy to answer questions. We have a mixture of people here. We have some university students, we have some clients, and we have some others as well. So everybody is free to come in and join, and hopefully we can add value for you. Okay, so without further ado, I assume you can see the screen, everything is fine. So the idea of this next hour or so is to talk about practical uses for statistical analysis in our actuarial work. The reason for this is that many times people take statistics classes and other math classes, and they ask the question, okay, how am I actually going to use this course? How am I going to use this in the real world? So that's what the idea here is, to just show you a little bit about the, what we use this for at Actuarial Partners, and then we can go from there. This is a subset of a much larger online learning platform. So I'll give you the link to that later on, but this is just giving you snippets of it. So we're talking about the statistics in particular. So we're going to talk about data analysis and an overview. We'll talk about modeling issues, risk margin, solvency management, and then finally asset liability management. And again, this is just snippets or a sample of what we use statistics for in actuarial science. Of course, in 1 hour, we can't talk about everything that we do in all the different aspects, but I think this is a wide range of topics, so it'll give you a bit of an idea. Okay, so before we start, we talk about actuarial science, but what is it that actuaries do in an insurance company? Okay, so the first thing is valuation. So valuation means calculating actuarial reserves. So if you're in an actuarial valuation department, you'll be calculating reserves. What this means is this is the provision you need to put into your accounts for future anything which is going to happen in the future. Let me give an example. Pretend that you have a 10-year policy and your premium, your single premium, the policyholder pays you is, say, $1 million. Okay? If that $1 million, that goes in as income for this year, okay? But if we don't set any provisions, then we're in trouble, because claims or other benefits, they might happen next year or in 2 years or in 3 years, sometime in the future. Because of that, we want to set aside this thing called actuarial reserves, so that in the future, as you pay off claims, whether it's death benefits or anything, we release our actuarial reserves. So the financial statements of the insurance company flows reasonably. Okay, so when we use actuarials, we use statistics all throughout calculating this thing called reserves. And we'll go through some of the aspects of this a bit later on. Another thing that actuaries do, they're involved in the pricing or product development teams. These are probably two different teams for many companies, but sometimes not. Pricing is the more technical subject. Pricing is when you're calculating profit tests. So other people give you what are the product features, the benefits, and all of these things. And you're taking this and you're coming up with assumptions. Based on these assumptions, you do a profit test, you determine what the premium rates should be, you talk about how much the surrender values should be, you can talk about risk management, or any other issues or problems with the product. You'll be the technical side. Product development is a bit more, is more of a wide field. When you're in product development, you're actually listening, you're talking and working with the marketing team. You're working with the sales team. You're talking to the underwriters, the claims department. And all of you are getting together to come up with a product which is good for the customers and good for the company. Okay, so that's another aspect of actuarial work that we do. Another one is risk management. Nowadays, a lot of actuaries, instead of being the appointed actuary or some other title, they're CRO or Chief Risk Officer, because insurance is getting so technical that more and more, we need an actuary to understand the risk management aspects. And there's a lot to this risk management team. In a risk management team, you're going down to the ground and you're trying to find out, okay, what are all the types of risks that my insurance company, that my company faces? Once you have all these risks, you must decide, can I get rid of the risk? For instance, if you're a life insurance company, mortality. If a lot of people die, that's a risk. You could have reinsurance. You could put a lot of reinsurance in place to cover this risk. Maybe all of your assets are in one asset class. Well, that's a risk. Maybe you can diversify your assets so that you're in a number of different asset classes. So this is diversifying your risk. And we can do this with so many things. But there's going to be some risks that you can't diversify. No matter what, you're an insurance company, you're going to face these risks. But these risks, we must monitor them. And that's what this risk management team is doing. They're monitoring these risks. They're looking at how whatever we're monitoring, how it changes over time. Based on these changes, they calculate mean, standard deviation, other statistics, and then they do modeling to find out what are the main risks of the company, and then how much capital, how much money we need to set aside or have available in case these bad things happen. Okay. Another team that an actuary might be in is IFRS 17. This is a fairly new subject. If you don't know what IFRS 17 is, you probably should do some research and understand, because for most countries, IFRS is something which comes in force this year. So a lot of the countries around the world, they implemented IFRS 17 for this year. So for all of these countries, you'll have a separate team usually doing IFRS 17. And this team has got a lot of technical work to be done. So there's really a ton of statistics, a ton of analysis, which is inside. Okay. Another team is business planning. Business planning for me is one of the more interesting subsets of actuarial science. What do I mean by this? Well, pretend that you're in management, okay? And management and the marketing team says, hey, if you give me $5 million, I can have this amazing plan put together. I can bring in business from a whole new source. It's going to be amazing. The question is, should the company say yes or no? You might say this is nothing to do with being an actuary, but this is everything to do with actuarial science. So we have our business plan. We calculate doing financial projections of the company over, say, the next 5-10 years. Okay, using all of our assumptions, and it's a little bit detailed to talk about all of those assumptions, but we're just projecting forward over the next 5 or 10 years the whole financial statements of this insurance company. Okay, and we do this under best estimate conditions. Now we say, okay, this marketing team wants to receive $5 million, $10 million, whatever it is, and in return they're going to give us something back. So we do our modeling. Okay, we're gonna give you this amount of money. In return, you tell us how much business can you bring in. Okay, let's look at the profitability of this business, how much money the shareholders get, take the present value, and then we can see how much business this marketing team needs to bring in for this new idea to be worthwhile. So the actuary by right is very heavily involved in the business planning side of things. And the last one is data analytics and everything along those lines. And this is sort of the sexy new field. People love talking about data analytics. So what does this mean is, let's say that you're in general insurance. Okay, should you have a marketing campaign? Should you target females or males, or do you not care? What do I mean? Well, who gives you better experience, males or females? Who's a better driver, males or females? So by digging into this, you can better understand where you should be focusing your attention. So let's say you're in Nepal, and you can look at your experience in Kathmandu and the major cities versus the more rural areas? Is the experience the same or is it different? Maybe people in Kathmandu are crazy drivers and there's so many accidents. Whereas once you get outside of the main city, there's very few accidents, or vice versa. So by getting into this data analytics, you can truly understand where you should be focusing your attention. Okay, so I hope this gives you an idea about some of the basic things an actuary does. And there's so much more. There's so much more to this. At a recent actuarial conference in Malaysia, we had one of the head of AirAsia, an airline, and they were talking about the fact they've got all sorts of actuaries or actuarial graduates in their company. So they're doing all sorts of data and analytics towards who do you normally sit next to when you're on the plane? Where do you normally go, and all of these things. So this will help them to market towards you in the future. Okay, so this is just to give you an initial idea. Okay, when we're talking about all of this statistics and data, we have to remember actuaries are not perfect. Actuaries do not know everything. Whenever you're working with statistics and data, you're calculating a mean, a best estimate. You're calculating 75th percentiles. These are all estimates. You've got a lot of data and you're calculating estimates. A different word is this, a guess. You're guessing. Actuaries are professional guessers. So we come up with a problem. What is the problem that we're trying to deal with? This could be a product we need to develop. This could be calculating actuarial reserves. This could be putting some sort of projections. What is the problem? Okay. We define this problem the best we can. We develop a solution, come up with our assumptions. We're not done. If you're in university and your lecturer gives you this problem, this case study, something to do, you hand it to the lecturer and then you're done. Not in the real world. In the real world, we develop a solution, we launch it, we use it, but we monitor the results. We keep an eye on things. And then so next year we can say, oh, hold on, geez, that was a terrible guess. And this happens in our work. I mean, oftentimes we are wrong. You imagine the actuaries in the year 2019, they were looking at all sorts of projections on how things are going to look like in the year 2020, 21, and 22. We were all wrong. Who would have guessed COVID-19 would come, right? Nobody would guess COVID-19 would have come. So that's what life is about, and that's what this actuarial control cycle is about. Monitoring things and then updating it as and when we go through. Okay, we have to talk about data if we're talking about statistics and modeling and things like that, because really garbage in, garbage out. If we don't have proper data, you can have all the most amazing statistics and amazing methodologies. You can be so technical, but it's still wrong because the data is wrong. Okay, so why are we collecting the data? That's the first question. Okay, earlier I told you, who's a better driver, males or females? Well, that's a fairly basic. We don't need to be very, very technical or detailed, but we do need to make sure that the gender field is there, right? Males versus females. We could talk about the color of the car because there's big differences in claims between whether it's a red car or a blue car and whatnot. Okay, so that's a certain kind of data that we need. On the other hand, we could be doing reserving or something like that where we need best estimate, 50th percentile, or 75th percentile, or 99th percentile. And this is much more precise data. Okay, let me give you an example. In the older days, before something called gross premium reserves, before IFRS 17, actuaries were prudent. We always use the word prudent, which means we need to make sure whatever we do, we're conservative. So we don't have to be exactly best estimate. So when I say best estimate, this means 50th percentile. When I say 50th percentile, if I look at my guess, my reserve is a guess, okay? My guess as to how much claims you're going to pay next year, as an example. Okay, 50th percentile means for every 2 years, 1 year I'm too high, my guess is too high. Another year, my guess is too low. That's a very precise thing. So we need to get very detailed data to do this. 75th percentile. This means we're being somewhat on on the conservative side. Okay, so 75th percentile. If this is what we need to do, and we'll talk about gross premium reserves just a little bit, or IFRS 17. Usually it's called EE plus PRAD, or plus padding, plus risk margin, plus risk adjustment, all these words. All of these words just mean we don't want 50%. We want something more than 50%. So let's say that this is 75th percentile. One time we had this very famous actuary from Germany come. There was a Munich Re conference in Malaysia. And so I asked him, okay, so what distribution, how do we model this thing and to come up with a 75th percentile reserves? His comment was, Hassan, I don't care. Why? At 75th percentile, most distributions give almost the same number. There's not much difference whether you use a normal distribution, a log normal, Pareto, whatever it is. There's not much difference. Okay. On the other hand, if you're doing solvency analysis or risk management, you're looking at, in Malaysia, we call it LCC, or the risk charges for mortality. Now we're at 99 percentile. At 99 percentile, now the distribution makes a big difference. Okay, so why are we collecting the data? What data do we need? So what are relevant fields? And what time period? So we talk about relevant fields. This is sometimes easier said than done. So let me explain. Sometimes we want, for a lot of our actuarial reserving, we need what's called entry date. When did the policyholder start and come in and start come to the insurance company and buy this product? So it sounds simple, right? Entry date. There could be many, many entry dates inside the IT system. The marketing team might consider the entry date to be when they first, the guy said, yes, I want to purchase this policy. So the deal is made. Whereas the underwriters might consider this entry date is when they receive the case file. The finance team might consider entry date as to when they receive the first premium. And the actuaries might be when the risk actually starts. Okay, so we need to be very careful with the fields that we ask for. Now, in terms of time period, let's say we're doing a mortality study, the people that are dying over a certain period, right? So we could look at this for everybody that died in 2023 in our company. Okay, that's nice. The problem is not many people might have died in 2023. So if we took 5 years, this is a lot more, we get a lot more data. If we have a lot more data, it's more credible. So time period. Okay, we'll talk about that a little bit more in a few minutes. When do we need this data by? When do we need to do our analysis? Whenever we're doing a statistical analysis or any kind of actuarial analysis, we need to understand what's our due dates. So for instance, if we're given 6 months to do an analysis, okay, we can collect all sorts of data. We can do all sorts of analysis. We can spend forever collecting data and putting it together. No problem. But if this is, say, for actuarial reserves, the regulator might want it within 1 month of the end of your financial year end. So your real deadline is 1 month. But your internal deadlines could be very, very different. For instance, we used to be actuary for this company in Malaysia, where one of the shareholders was a bank. This bank was always very proud. They're the first bank, the first company to give their financial statements to the stock market, Bursa. So they're the first, which means the end of the financial year is December 31st. We had to finish our actuarial reserves by the 3rd of January. No exaggeration. So in this case, we have to be very quick, and the data that we need, the analysis we do, is going to be different. Another one, what system do we extract this from? It would be nice if an insurance company has just one system. That would be nice. Many cases that's not true though. Whether sometimes you merge two companies, so now you might have two data systems, two IT systems. You might have a regular IT system, but with some products being outside the system. usually group insurance, direct marketing, sometimes bank assurance. It's in a separate system or just done manually. So we need to understand where we're getting data from. Now, we need to make sure our data is correct. We can do lots of amazing work, but if our data is wrong, then it's still wrong. So this is data checks. We'll talk about data checks in a minute or two. Okay. The last one in terms of this slide is, who do we escalate issues to? We will have problems. There's no such thing, no matter how good the company is, that you're going to do all this, you're going to collect data and everything is going to be perfect. It'll never happen. So what's the next step? So we need to understand this. You know, if you're in university, you'll just ask your lecturer, okay, what do I do? But in this case, we don't have a lecturer. We need a process in place. Okay, so this is so that was the basics on the data. Now, in terms of data checks itself, we always talk about three things when we're doing data checks: accuracy, consistency, completeness. Accuracy. Is the data accurate? So what do I mean? So if we look at the data and we see an entry age of 30, so the person bought an insurance policy at age 30, okay, that makes perfect sense, no problem. But when we look at the entry age, and the entry age says -5, this happens, we know something is wrong. So in some cases, it's simple to do. In other cases, it's a lot more difficult. For instance, what happens if the entry age is, say, age 75? It's not impossible. The company could have a product which they're catering to old people, but it's not common, right? So this is where we need to be careful as to, for each plan or for each company, what is considered reasonable and acceptable for all of our different data points. Okay, consistency is another one. Is the data consistent from last year to this year? A lot of times, the IT system is not an actuarial system. It's used for everybody. The marketing team uses this, the underwriters use the IT system, the claims department, management uses it for their own statistics and whatnot. So everybody uses this IT system. So sometimes another department will say, hey, you know, this is not what I'm looking for. What I really want is for you to look, this should look something different. Okay. And sometimes they make changes, but they don't tell the actuarial department. So we need to make sure things are consistent. So what are some of the major issues that we see? The simplest one is, for instance, day, in the date, day, month. So 28th of September. Other times it'll be September 28th. That's a sort of a famous one that tends to go off. The biggest problem that we had one time, this is a Malaysian company, was the gender field. So in our programs, mortality is different, whether you have males or females. Women live longer than men. Okay, so we take that into account in our modeling. So in this case, something went wrong. When we looked at the gender field, okay, there's a lot of M's and F's, male, M for male, F for female. But over the last couple of months, the most recent couple of months, all of a sudden there were L's and P's. Lelaki, perempuan. That's in the Malay language for men and women. So we changed language. So the consistency went off. And this causes us problems. So we need to make sure that there's a consistency every time we do this work. The last one is completeness. So completeness, we must make sure we have all of the data. And this is easier said than done. So somebody gives you, the IT department gives you data, and you need to do all of your analysis with this and your statistics and all your modeling. You need to make sure you have all the data. So how we do this is in the financial statements, the auditors and whatnot, the auditors would look at your premium income column field very, very carefully. They'll do very detailed checks to make sure the premium income is exactly correct. Well, okay, if I have the data of all the policies that are in force right now, plus all the ones that went out of force during the year, meaning the policy that died during the year, the policies that lapsed, they stopped paying premiums, the policies that matured. So I've got everything which happened during the year in my data. And I know all the different things like how often the person pays premium, how much the premium is. I can do a modeling to determine how much this premium income should be. So I put this, what I think the premium income is. I compare it to what the auditors have checked is the premium income. And I can get this within, say, 5%. Okay, I'm comfortable that we have data. Data is complete. Okay, and we have to do this regularly. If you don't do this, then the issues just keep building up and building up and building up. So it's garbage in, garbage out. Okay, when we're doing our modeling, so we've got a few core principles when we're modeling any kind of statistical analysis. Number one, reflect reality as closely as possible. As actuaries, we're trying to guess the future. We're predicting the future. So we're trying to model reality. So when somebody gives us a project in an insurance company, they're never going to say, hey, can you do a model of the mortality assumption and come up with the best estimate returns? They're not going to give you something like that. It's going to be, we need to design this product. This product is a little different than our other products. This product is not for our normal policyholders. This is going to be for a microinsurance. We're going to go down to the real poorest of people and we're going to sell them insurance. And, so the market segment is a little different. So we have what the mortality should be for our regular business, and we need to model this new segment. Okay. Our goal with this new segment, model the reality of that segment as closely as possible. We need to always look at actual versus expected in everything that we do. This is the actuarial control cycle. So we make an assumption as to what we think is going to happen in the future. Now, as we get 1 year later, we need to do the actual analysis to find out, did it actually happen? Or did we overestimate? Did we underestimate? And what can we do to fine tune things? Also, is choosing the right data set. We need to understand which data sets to use, and we'll get into that with this slide. Okay, so data fields we've been talking about. So what are the driving factors behind this assumption? Whatever you're trying to do. So again, when somebody gives you an assignment in insurance, it's very rarely going to be, I want you to model mortality. I want you to model the probability of lapsation. I want you to model. It's rarely going to be this nice, clean, simple problem statement. It's probably going to be something a lot more complex and hard to model. So we need to understand and discuss what are the driving factors behind this assumption, whatever you're doing. Whatever we can determine the factors are, this is what we can model. So let me give you an example. Lapsation means the probability of somebody, they buy a policy, and then, for instance, they pay the first year's premium, but they don't pay the second year premium. Okay, so they lapse, they don't have the product anymore. Okay, so that's the first year lapse rate. Okay, so whenever we're doing this thing called lapsation, we normally look at it single premium versus regular premium. Because single premium, you only pay one premium, and then you get coverage for 10 years, 20 years. So once you pay the premium, you don't think about the product anymore. So the lapse rates are very low. Regular premium is you pay a premium every year. So we would normally look at this lapse rate year by year by year. So it's policy duration. That doesn't have to be the case. We sold annuity plans in Malaysia for a couple of years. The product was such that at age 55, the product went and you started receiving this annuity. But you couldn't surrender the policy after you attained age 55. Which means people were lapsing the closer they got to age 55. Nothing to do with duration. It was based on attained age. Okay, so there's this, we need to talk about what data fields, what is the driver of this assumption. Okay. The time period is another very important one. So how much data do we need to be credible? So this is a balance between relevance and credibility. So take mortality. Let's say you say, okay, I want to be relevant. So I'm going to use mortality over the last 3 years. I'll collect all the people that died. I'll calculate the people that are still living. I'll calculate my mean, standard deviations. I'll do my modeling. I'll calculate all these different, percentiles and everything. All that is good. But is 3 years the right number of years? Right now it would be 2020, 21, 22, COVID years. Do we think that the COVID, now it's COVID-19, is it going to be, that's it? It finishes and then we're all going to live a happy life from here on out? Or now that we got COVID-19, this extra mortality, next year there's going to be COVID-20, or COVID-21, or who knows what? Who knows what's going to happen next? Right. So if we take 3 years, it's going to be right in the heart of COVID-19. Do we want this? So this is a discussion. There's no right or wrong answer, but these are things that we need to consider, the time period. So for myself, I would normally look at 5 years for everything that I do. I might not use 5 years, but I want to see 5 years. Because we can look at, for instance, all the people that died, or car accidents, whatever, over, say, a 5-year period. But I also want to look at it year by year. Because what's happening? Is the trend going up? Is the trend going down? Is it just going up and down? So that there's no real pattern to it. These are all things that I really want to know in order to determine what our assumptions are. So we have mathematics using the data and the statistics, but there's a lot of non-mathematics, the why, understanding the underlying reasons and using that. Okay, so I've been saying, if you use, say, 1 year of data, that's going to be much more recent. So the more recent data might be more relevant to you, but it might not be as credible because you have less data. Okay, so we've been talking about a lot of this actuarial work. So let's talk about limitations just for a minute, because actuaries are not perfect. And this is something, when we're doing our analysis, we need to remember that we're not perfect. For instance, the past might not be reflective of the future. Just because, I'm an actuary in the year 2019, I'm putting together all this data and statistics, that doesn't mean that's what's going to happen in the year 2020 and 21. It didn't happen. We had COVID-19. Actuaries can't predict COVID-19. Right. Just like we can't predict COVID-20 next year. Whatever, I hope not. Whatever. We can't predict this. So it's just data. Data is not telling us the whole story. Now, the reason I say something like this is that a lot of times we'll do our analysis and then somebody non-technical, a marketing guy or sales or somebody else will come and say, no, I see what you guys have done, but it doesn't make sense because of this or that. And that's going to be a non-technical thing, they say. We can't just say, no, I've used my numbers, my data says this, I'm the actuary, I know what's going on. No. We need to listen to other experts that are in the field that understand underneath the data better than us. Okay, there's random events. Things happen, right? And it might not happen again. COVID-19. Maybe we can say COVID-19 is a random event. It happened. It's never going to happen again. For general insurance, we had the floods, Thai floods a couple of years ago. It caused all sorts of havoc. All right, that was really bad. Maybe it's not going to happen again. So this is all part of our analysis, especially general insurance. When you see certain events, is it something which is going to happen again in the future? Or is it something which is just a one-off event? It's not going to happen again. Outliers. Okay, so that's an important aspect and limitation of what we're doing. The scope of our work might not be well defined. And I would say most times our scope is not well defined. When you're in university, your lecturer will tell you exactly what you need to do. And that's great. But when we get to working in an insurance company, many times people know there's a problem. They can see that maybe profits are dropping. They can see that agents are having a hard time selling products. They can see our solvency ratio is reducing. So they can see that there's something going on, but they don't know exactly what the problem is. So our scope might not be well defined. So we need to be careful with this. Data can be difficult, expensive, and time-consuming to collect. Yes, I understand. We have AI, and this expensiveness and difficulty is reducing, but it doesn't take away the fact that we don't always have unlimited resources to collect data for months and months. Sometimes we have an assignment and it has to be done, over the next 3 days, or it has to be done very, very quickly. So it's always a balance. It might be difficult to collect the data that we need. So we need to find a simplified approach to whatever we're doing. The next issue is results might not be well communicated to non-technical people. When you present, you might do an amazing job. Calculate, go through the data, make sure the data is accurate, consistent, complete. Everything is perfect. You do all this amazing analysis and modeling. And then when you get to the board of directors and upper management, you explain what? You explain all about your Pareto distribution and why this is such an amazing distribution and why these numbers are correct. But if these non-technical people don't understand what you're talking about, they might not listen to you. They might not take your advice. So again, your work is useless if people don't take your advice. Law of large numbers. Whenever we're dealing with statistics, we're dealing with the law of large numbers. A lot of things happen. Based on a lot of things happening, we can go in and analyze it. It doesn't always exist. Let's say you're insuring for fire risk for Petronas Twin Towers, very big, huge building. Okay, so we can say, okay, this is a special building, right? It's not like the smaller buildings. Okay, fine. So let's just take a look. So if we say insure 20,000 Petronas Twin Towers, we can look how many had fires and what happened and what the claims were like. How bad did it get? Did the whole thing burn down? Was it just 2 floors? What is the real problem? What is the real risk here? We don't have 20,000 Twin Towers, right? There's only a couple. So we can't use the law of large numbers. So again, guesswork. And then finally, actuaries don't know everything. We do the best we can, but we're using the data that we have. Okay, so let's get into some specific examples where we're using the statistics and statistical analysis in our work. One is incorporating risk margin. When I say risk margin, there's a lot of words for this thing called putting some conservatism into our results. We have our best estimate, whatever this is, 50th percentile, and then we want to have some sort of conservatism. Sometimes we call it risk margin, sometimes we call it padding, sometimes it's called padding, sometimes it's called risk adjustment. There's so many different words. Each country will have their own word and words for this, but it just means we want something conservative. In some countries, we don't have to do this. Just because depending on what country you're from, there's a number of different countries here. So in some countries, it just says, what is your best estimate? When we want this risk margin, just take 1.2, 120% of it, fixed. But in many countries, such as Malaysia, we want a specific confidence level. So we want, say, the 75th percentile in Malaysia. So our actuarial reserves are always at a 75th percentile. Okay. Whenever we're talking about this, I would rarely use the word 75th percentile. I much prefer to use 3 years out of 4, our reserves are expected to be sufficient. So 3 over 4, 75th percentile. For a non-actuarial person, a non-technical person, talking in terms of every 3 out of 4 years, they understand this a little bit better. With best estimate, 1 year it's going to be too high, 1 year it's going to be too low. Best estimate. Many times regulators don't want our reserves to be, every other year our reserves are too low. But they don't want it to be very conservative. So that's why you see 75th percentile is a fairly standard number now. And not just for reserving, it could be IFRS 17 as well for some countries. Okay, now we're talking about solvency, risk-based capital is what we'll say. Okay, then the factors might be much higher. So it could be 99 percentile. This is fairly standard, 99.5. 99 percentile means our reserves are only inadequate 1 year out of 100. Okay, so when you say that, now people understand how conservative we need this if we're talking about a 99 percentile or solvency. Okay, so I'll use 75th percentile for the next few examples here. Okay, so when we're doing this risk margin, we would whatever our assumption is. So all sorts of assumptions when we're calculating an actuarial reserve, for instance. We have probability of dying, we've got investment income, we have expenses, we have lapsation, Could be loss ratios for like critical illness or certain things. So there's all sorts of assumptions. Okay, so for each of the factors that drive this actual reserve, we need to use the data, collect data. And again, I would normally look at a 5-year period overall, and I would look at it year by year just to see the trend, just for myself. Okay, so we get a 5-year period. We calculate the mean and the standard deviation, and we use a distribution. We could use, say, a normal distribution, a log normal distribution. You could use Pareto distribution, whatever you want. You could get very, very technical, or you could be just something simple. Okay, so for a lot of countries, gross premium reserves are calculated using our 75th percentile assumptions to get more conservative reserves. And then this is called our risk margin, our PRAD, our PAD, our risk adjustment, whatever it is. This is going to be that amount is what we're looking for. Okay. Now, one thing to notice, I'm talking about reserves, right? The reserve should be conservative at 75th percentile, not a particular assumption, mortality or something else. Okay. So what do I mean by that is, let's say you have investment income. The lower your investment income, the higher your reserve. Clear. Expenses. The higher your expenses are, the higher your reserves. Clear. Mortality, lapsation, not always clear. Sometimes higher mortality will give you lower reserves. And the same thing for lapsation. So in this sense, we need to understand whatever we're doing. In this case, it's actuarial reserving. Okay. What is going to drive our reserves? So we have to test high mortality, high lapse, high mortality, low lapse. You know, these 4 assumptions, 4 scenarios to calculate our reserves. In some countries for life insurance, but in most countries for general insurance, there is a diversification effect, which means if a lot of people are take COVID-19, you know, in Malaysia, you can say, okay, what happened? Mortality increased, right? So certain things increased because we had COVID-19. Okay, understood. But the motor claims went way down. Why? Everybody's at home. You know, if everybody's sitting at home, nobody's driving their car. So the motor insurance, automobiles, there was very low claims. So it's beautiful, you know. So we would love COVID-19 to be around for that class of business. But another class of business is going to be worse affected because of COVID-19. So they balance a little bit. Diversification. Okay. We have this a little bit for life insurance, but it tends to be more for developed markets. So if you have, say, an annuity and a regular death product, for annuities, if more people die, it's good for you. Your reserves go down. But if more people are dying than what you expected, reserves are going to go up for other products. So they do balance each other. But in the developing world, we don't have that many annuity plans in force. Okay, so we've been talking about the general concept of risk margin, but we could get into details if you wanted to. For instance, are we doing this analysis for the whole company? Or are we going to do this just on a plan-by-plan basis? Or are we going to go through each and every policy, we check what is going to be the right way to come up with 75th percentile. 75th percentile for one policy is not the same as 75th percentile for the whole company. Okay? It's not additive. You can't add up, 75th percentile for every policy and then get to the final number, and it's going to still be at 75th percentile. Okay? So we're getting into details, but, just to explain that we need to talk about what we actually need to do. Each country is going to be a little bit different. Okay, we talk about distribution. So the 3 distributions we tend to see for risk margins is normal distribution, log normal, and Pareto. At a risk margin or 75th percentile, there tends to be not much difference for the different distributions. So we don't normally worry about this. So I've seen actuaries do very complicated distributions, but normally it's normal or log normal. If you If you have no idea what's going on with the data, you really have zero idea, you're clueless, you just collect the data, calculate the mean and standard deviation. Normal distribution is a typical or standard thing you would use because it's a standard. If you don't know, just use the normal distribution. For me, when I'm working with insurance companies, I will use log normal. The reason I do that is because log normal doesn't go negative. If you got a mortality rate, you can't talk about a negative mortality rate, right? People are not going to come back to life unless you have like insuring ghosts or something. It doesn't happen. So log normal looks a lot more reasonable to me. Okay, so that's on the reserving and where we use statistics in reserving. And again, I'm going through this super quick, just a couple last sections here, and then we're done. But this is we can get a lot more detailed for this. Okay, so capital. What does capital mean? Capital is extra money setting aside in an insurance company. Okay, so we need this for a lot of reasons. Operational cost. If you're going to work at an insurance company, you kind of want to get paid your salary, right? We need money for that. So we need extra money around to pay your salary. Consumer confidence. Well, especially if you're life insurance, if you go out and you buy furniture, you say, okay, I want to get a new couch or a new table. You go to the shop, you buy the furniture, and within a day or two, they'll deliver the furniture. You're okay. You can look at the furniture. But for an insurance product, a life insurance product, okay, you pay a premium and then you die. What are you going to do? You can't go back. You can't like haunt the person to say, hey, pay my family the money. You can't do it. So you must be very sure that this company is going to pay their benefits, which is why we have capital available. There could be unexpected shocks. COVID-19 wasn't that bad on the insurance industry, all things considered. God only knows what COVID-20 is going to do, as an example. There could be future opportunities. Your marketing team comes to you and says, hey, give me 10 million US dollars. I can make us so much money in the future. You need money for this. And then finally, you have stability and confidence in the financial system. What does that mean? So let's say for the Malaysians, okay, if all of a sudden you get here on the news, this tiny, small shopping mall goes bankrupt, it'll make the news. You might be upset, but really you're not going to be too worried. But imagine if you wake up in the morning and you got the news, Maybank went bankrupt, CIMB went bankrupt, Etika Insurance went bankrupt. Now we have a problem. The whole financial system could collapse. So we need to make sure that banks and insurance companies in particular are well capitalized and they can handle whatever comes their way. So we do this for an insurance company. We need this capital to pay claims, expenses. New business could be more or less than expected. Investment risks, ALM or asset liability management, lapsation, operational, so many things. Okay, and we can go through these. I won't go through it in much detail, but all of these things. You have counterparty risks, market value risk, illiquidity, and whatnot. So each one of these pieces that I mentioned, there's statistics in each one of this. So for each one of these things, we have, for instance, default risk. Okay, this is something we need to model. It's probably different whether it's a AAA rated risk or AA, single A, or not rated. So we have ways for this risk, ways of determining what is a reasonable best estimate, and then how volatile this could be. We have data. So each one of these circles, we can collect data and do modeling. Same thing on liability, mortality, lapsation, expenses. We talked about this already. ALM, it could be interest rates could move, exchange rates might move, just to explain. So when you have an insurance, especially life insurance, you have an liabilities, which is whatever the product that you sold. Normally they'll give you the premium first. You collect premium, you invest that money, you use that money to pay off whatever your liabilities are. So your assets and your liabilities. In a developing world, the duration of your assets tends to be lower than the duration of your liabilities. We try not to, But a reality is that there tends to be a mismatch, okay? Which means if the interest rates move, and it moves differently for long-term interest rates versus short-term interest rates, this is going to create strange things might happen to your assets and liabilities. And you can just look at this COVID-19 problem. I mean, look at Sri Lanka. There's a number of countries where Kenya, where there was all sorts of chaos in the interest rate yield curve, which affected assets and liabilities differently. So this is all this kind of a risk. This is interesting but challenging to model. We'll talk about this in just a minute or two. Operational risks could be your processes might be wrong. People, someone might just decide to fraud and, steal money. Your systems could go haywire. Right now, you get IFRS 17. People are spending millions and millions of dollars on IT systems. And then who's to say that, you press a button, when IFRS 17 comes online, oops, it doesn't work. You need a new system. There could be external events as well, whether it's hacking, cybercrime, whatever it is. Okay, so that was on what capital is. Now, just to mention that our statistics is not just the pure mathematics. There's a lot more involved here. So RBC is risk-based capital. So, and this is all for the board of directors. Solvency and all of this kind of analysis is the board of directors. As actuaries, we need to make sure we've done the homework. We've done the statistical analysis so that the board can make a proper decision. For instance, let's say your regulator says, we talk about RBC. This is the risks. What are the risks the company is facing? And we calculate charges or risk charges, whether it's liability risk, whether it's asset risks, whatever, the things that I just mentioned, the previous slides. We might come up and say, okay, we add up all of these different risks, this calculation. Maybe it's going to be, say, $10 million is the amount of capital that I need. Well, I look at how much extra money do I actually have with the company. If I actually have in the company $10 million, so I have $10 million, I need $10 million, 10 over 10 is 1 or 100%. My capital RBC or CAR ratio, capital adequacy ratio, is 100%. Normally, regulators will say, I want you to have at least, say, 120%. So you must have 120% at all times. As long as you have that, you're good. Okay, that's your regulatory level. But we don't want to be right at that level. Normally when you're at that level, the regulator is going to give you a lot of love and attention. Love is good, but love from regulators, not so good. We had a client years ago in Malaysia. They were always struggling. Their salt capital was just barely enough for years in a row. So the regulator actually had a desk in their company. So every day the regulator would be sitting in their company, smiling, going around, asking questions, feel the love, that kind of love is difficult. So if the regulator says you must keep 120% solvency ratio at all times, we want to set an individual target, which is at 150% or something higher. It's not random. It's using our statistics, our data, to find out what kind of one-off events can happen such that if it happens, we're still up at that 120%. Okay? And then there's a plan. We need to put beyond this target level, we need to put plans in place. For instance, let's say we come up with 150%. Okay? So we want our solvency to be at 150% at all time. Fine, good. What happens if all of a sudden it got to 145%? What are we going to do? We need a plan. Can we change the type of products that we sell? Can we change the assets we invest in? A lot of times we say, we just need more money. Shareholders, can you give us some money? That takes time. You can go to your parents and say, hey, I want $10. They'll give you $10 easily. But if you go to the shareholders and say, I need $10 million, that's a tough, no matter how rich your shareholders are, that's still a tough discussion. It's still going to take time to put in place. So we need plans in case something bad happens. We need to monitor this regularly. So if something bad starts to happen, we can take action right away. and then maintaining this appropriate levels at all times. Okay, so we've talked about different thresholds. This could be in terms of this internal target levels. It could be if the stock market drops by a certain percentage, this is a big enough loss. If that happens, we need to take some actions. Or if our new business drops by more than 20%, then we need to take some action. How do we determine these thresholds? Actuarial statistics. Put the statistics in place, find out what drives our solvency, and for each one of these, do the calculations. How bad do things have to get in order for there to be a problem? And again, we can take actions such as reducing the risk or increasing the capital. Okay, and there's many things we can do. We can raise capital, we can increase our reinsurance, change our mix of business, we could sell some of our business, change our assets, or not give any bonus to policyholders, not give surplus to policyholders or shareholders. Okay, a lot of stuff we can do. Okay, we're almost at 1 hour. Just need a couple of minutes for ALM, and then we're done. And we can go for any questions after that. ALM, asset liability management. This is the most technical that we do, and the most interesting, to be honest. We have two separate statistics involved. We're going to generate the economy and, what could happen with the economy. Based on each of these potential things that happen to the economy, we use our actuarial software to determine what happens to the company. Okay, and you can say, okay, what do we mean by what happens to the company? Well, it depends. Every insurance company is different. Every insurance company, some might say, hey, I don't want to be insolvent. 95% of the time, we must make sure this company is solvent. This is my rule. We must put this in place. Other times, it could be something different, such as transfer to shareholders or the need to inject capital. So what I would normally do for this, I would ask the CEO, what would get you fired as a CEO? And every CEO is going to be different. They might say, I have my target transfer to shareholders. I can't miss that target for 3 years in a row. If I miss that target for 3 years in a row, I'm dead. They're going to fire me. All right, that's our goal. So we need to make sure that we look at our ALM, what's going to happen to the assets and everything, really. Feed it into our actuarial side to make sure that whatever his KPI is, the CEO, we satisfy this. Okay, so we need to understand exactly what's going in, what's involved with each company. Every company is going to be unique. As an aside, this is what we're talking about right now is climate risk, and how does climate risk affect the insurance company? So it's the same idea. Okay, and we can use very expensive software for this. For ourselves, it's called Moody's Analytics. So we work with Moody's. So they do the economic side of it. We do the actuarial side of it. We work with Moody's, but you can do this yourself. You can build it. It's not an easy thing to build, but you could build it yourself. The disadvantage of building it yourself, it's a lot less accurate. The advantage is that by building this, you've really helped to understand exactly what's going on at your company, which is a good thing. So, I won't get into this too much, but when we're talking about stochastic simulations, whether it's using a software, whether it's using Monte Carlo simulation, whatever it is, we're not talking about doing it once. We're talking about, say, 1,000 runs or 1 million runs. For most things, you just need to do 1,000 runs. You don't need to have millions of runs because it's going to take you a lot of time. Because again, you're balancing time with accuracy. Okay, and you calculate different, say, asset portfolios. And what is my expected return? What is my deviations? Whatever it is. And we put this kind of a graph together to say over time, how much capital is required if this particular asset mix is used. What is my, how much money do I have? What is my solvency ratio? Okay. And then we look at different portfolios. For instance, one thing a lot of CEOs in particular, upper management, if they're not actuarial, they might say, Hassan, well, let's just put our money in something simple like deposits. It's safe. There's very low risks here. So I'm not going to lose a lot of money. Good, that's fine. You're not going to lose a lot of money. That's this least risk portfolio here. But your investment income is also going to be, on average, fairly low. And maybe that's not going to be enough to keep you solvent, or your solvency will be not too good. There could be other effects as well. Because whenever we price a product, we might price a product and say, okay, in order for me to be competitive in this market, I must use an investment return of 6%. If I don't use an investment return of 6%, I simply cannot compete in the market. Okay, if that's the case, then okay, we need to look at the various asset mixes to give me the 6%, and we need to find the most efficient portfolio. And that's what the stochastic analysis is for, to find out what is the best asset mix to give me the highest return for the minimum risk, or the minimum whatever it is we're doing. In this case, we want it to be at least 130% solvency requirement, even at the bottom 5% of results. Okay? And this depends on the company. Every company is going to be different. Some people might say, don't inject capital. Whatever you do, don't inject capital. If I need to go to the shareholders and ask for more money, they're going to fire me. Okay, that's your requirement. Based on that, let's do the analysis, come up with a whole range of asset mixes, and calculate this. Okay, I went through very, very quickly. We started a few minutes late, so it's been pretty much exactly 1 hour. This is just the tip of the iceberg. Okay, so really, go to our website at actualpartnerslearning.com. Okay, and you can explore. We've got a whole range of courses here for you to try out. For each course, we have a free version and a paid version. Okay, so you can always go in and look at the free version. And we put this together in one course. If you go there, this Actual Partners Learning, it's on something called Moodle. So if you're a student or recently a student, you might have already used it. A lot of universities use Moodle, so you're already a member. So you just click on it, sign into your Moodle account, and then you're good to go. Okay, if not, you just sign up. It's for free. So you sign up, and then from there you can look at, review the different courses. Or we have one course here called First Steps into Actuarial Science. This goes into a lot more detail on everything that I've just said. Okay, it's totally free, so feel free and check it out.